everybody. Welcome to Enlightened Investor. We're on our second part of our Design, Build, Protect series on build, and we've got a great day for you here. Again, I'm Dr. Lure from Bradley University. That there is Mr. Fiduciary Mike Mahoney. And, I want to start off today with saying, happy birthday, Mike.
Thank you.
Yeah.
60, man.
Oof,
Woo.
60.
Wait till you get there.
Are you thinking about life a little differently these days?
It's interesting. I've had, obviously 60 birthdays now, right? And I never really ever gave a birthday much thought. But for the last 30 days, probably prior to this birthday, I found myself reflecting just because I'm going to have a lot fewer birthdays with a zero on the end going forward, right? So it gets you reflecting. But no, it's great. It's fabulous. I'm looking forward to it.
Well, part of the team's going out for lunch today, and we got a few golf trinkets for you there.
Right, yeah.
To enhance that.
Well, and then next week, just kind of push myself for turning 60. I'm going down to Florida, Fort Myers Beach. This is going to be the start of this journey, and we're going to ride our bike to Key
ride.
West.
Yeah, that's crazy.
That's the third time I've done it, 280 miles. 60 years old. We'll see how that all works out.
In the rain, in the sun, right?
It's tough, for an old guy.
Well, that's pretty.
Yeah.
It's pretty.
But anyways, thank you for mentioning that.
So today's lecture. Back to build. I think we're going to talk today about evidence-based investing and really, didn't that kind of bring us together a little bit, Mike? Like this build idea. How do we get together? First, we meet each other.
Yeah, you mentioned that's totally how we got together. I mean, when I was all excited when I moved up to Peoria back 2007 with my business, and it's all rooted in academia, our whole process and in strategy and everything else that we do, and a lot of our strategic partners. And I thought, well, heck, I got to go to Bradley University. It's our leading academic university here in Peoria. We'll connect. I'll have these professors. We'll have this big, great sharing of data and all talk about this stuff and bring it out to the community. And I went to you weren't the head of the department back then. It was a different person. And it fell on deaf ears. I could tell. It's like he totally was a proponent of active investing and stock picking and manager picking or whatever. And it went nowhere. And then I forget how we met. I think I met you through Dan Cleveland one day at lunch or something.
It could be even that Ollie program you put on with Swidrow. Yeah, and I had you come
Shout out to Dan Cleveland over at Virginia Tech.
Yeah. And don't forget you brought Larry Swidrow.
Larry's been in twice, at Ollie and talked. So, yeah. Well, then I came in and talked to your students a few times. So we've been talking for a decade probably at least, right?
That's right. So, folks, and I'm an academic still, and we still find in our finance departments, our economics departments, that people want to be stock pickers. They think they can, beat the overall market with this efficiency we have built in. It's tough to do, and
I think it's even more prevalent nowadays. I don't know. It's crazy what goes on nowadays because you got the meme stocks and Tesla and you name it. I mean, ARK. We talked about Kathy Woods. I mean, it's just. It's going on, and it's great. I think it's great if you want to play around with a little bit of your money, fine. But for the bulk of your money, you need to be serious, and that's what we're going to talk about.
Yeah, so last week's discussion was really on the design of building a plan and an overall portfolio, and today's going to be on build. And so today I'm going to really kind of turn over to the birthday boy here a little bit to start us off with talking about build and kind of building a plan that's right for you. You want to start us off with that, Mike?
Yeah, but I think first I want to read back and visit people and just kind of explain, design was really, meeting and talking and really finding out what your goals and your values are and your key relationships. And then we go forward now to build is to build that plan. And also within building a plan is you're building the portfolio, right? And so today we're going to talk about, the academic theory that I recommend to you when you're building your portfolio. And then we'll go into the second part and look at the more detailed process of asset allocation, the importance of the portfolio, the thing that really drives performance and the variance of performance.
Yep, and that's really what kind of attached me to what you're doing over here is that theoretical part. I've read Rand Walk Down Wall Street. I've read the challenges involved. But when we talk about evidence-based investing, all those Nobel laureates that talk about it, from Eugene Fama to Milton Friedman,
it goes way back. I mean, and plus I think some of the more important names to mention is like Harry Markowitz, with modern portfolio theory, and then you had William Sharp come along with the capital asset pricing. And I'm sorry, we're going a little deep on some of this capital asset pricing model, and then Fama French with the 3-factor, and then Fama with the efficient markets. There's a lot of information out there that supports this. And also I think the data shows up when you compare the active manager returns to a simple index return
Can't do it.
speaks for itself.
Yep.
Data, right? We're all about data here.
Yep. Yep. Definitely, folks, you want to watch the end here to see this powerful data that actually it's there. It's been there for many years, but no one knows about it. So
Well,
looking forward to this great
and you
session
need to
today.
have I mean, there's a core. You need to have if you have a manager or if you're doing it on your own, you need to have a core investment philosophy. And just picking stocks or picking managers or market timing isn't a core strategy. I mean, you need to focus. The empirical data shows that asset allocation is the primary driver of the variance returns, over 90%. And when I mean asset allocation, I mean how much is dedicated to stocks versus bonds if you're going to blend a portfolio, because unless you're incredibly young, you do want to have some bonds within that portfolio. And then you can break it down into sub-asset classes of, U.S. stocks, international stocks, small stocks, large stocks, value stocks, growth stocks, and we'll get into that more into the next video. But I mean, those are the key determinants of a portfolio. And unfortunately, most people don't use that approach. Even professional managers, for that sake. I mean, we have a local manager here in Peoria, and their idea of diversification is 70 to 90 large cap U.S. stocks that pay dividends, and they call it value approach. And it's basically the subjective nature on their part. And I think if you were to benchmark them to a simple Russell 1000 value index, which would be what, large value U.S., they probably trail. So it's...
Yep, 90% of the return comes from there.
Correct.
Yep, 90%.
So we're going to take a deeper look at that today.
So to put it in simpler terms, we're going to do a quick little analogy of the golf game that we're so great at here, right?
Right, we got a great, yeah.
So how can we use that as an analogy, golf as an analogy?
I think it's a great analogy to use, because think about it this way. If you weren't a golfer, and like most people aren't professional investors or even professional investors, if you're going to pick up a strategy and you're going to go play golf, it'd be like going out and say, I'm going to play Bryson DeChambeau, or I'm
Rory
going to play
McIlroy.
Jordan Spieth. Or Tiger Woods, and I'm going to win. Because and let me just explain this, how you would look at that from a market perspective, and you look at all the academic data we showed. What they found is, I mean, you think about the markets today. 90% of the market trading is professional traders, mutual funds, hedge funds, etc., pension plans. They're trading against one another, and they're very smart people collectively. I mean, and the information trades incredibly rapidly now with the internet, much more so than we had in the past. It's available to everybody. And to give an example of that, like one hedge fund, there's a hedge fund called D.E. Shaw. Jeff Bezos, by the way, was
part of that group.
He rooted from that group. They have like 70 PhDs that work at this one hedge fund. They use logarithmic program trading. Each has different industries, different stocks or sectors they follow.
Yeah.
And that's one company. So you multiply that times all these people out there. That makes the market pricing pretty efficient. It's not perfect, but it's really efficient. And as soon as news travels, which travels instantaneously, the price changes to reflect that news, which is why active investing is a very difficult game.
It's a tough game, Mike.
And then I think we need to be a later topic. We'll do another video sometime. But then if you look at the minority of active managers that do win, it's really not much bigger than what percentage you would expect to come from just random luck. So now we can get into that topic, outcomes, lucks. But that's
the whole persistence.
Bringing Mitt back in.
It's luck versus skill. We got Dr. Mitt Sinha coming back.
Right, exactly.
All right, very good. Okay. Well, we hope you enjoyed today's first part series of really a building our plan, and we're going to get into the practical stuff next time. So,
correct.
So please look forward to our next show, next episode, right? And our 3-part series. We're kind of almost on Netflix these days, kind of series.
Right. Yeah.
All right. Thanks a lot, folks. Take care.